NIO was once hailed as one of the most promising electric vehicle manufacturers. With its premium branding and innovative battery swapping tech, many investors hoped it would become the next Tesla killer. But despite some impressive tech, NIO hasn't quite reached that level yet. In this video, I'm going to cover NIO's financial performance to date and offer my opinion on whether you should invest in NIO right now. Financial losses have plagued NIO, and they're increasingly reliant on external capital. Now, this raises serious questions about whether NIO is just a high-risk gamble in a notoriously competitive sector. While some argue that NIO is significantly undervalued, I find it hard to be anything but cautious until these financial challenges are resolved. Now, let's talk growth. Now, NIO has been relentless in its push for expansion. In December, they released a record number of 31,138 vehicles, which sounds great, right? But there's a catch. Revenue growth is actually slowing down. In fact, last quarter showed a 2.1% drop in revenue compared to previous year. Now, NIO is launching new sub-brands like Onvo for mass-market vehicles and Firefly for European customers, but this will likely increase capital expenditure and possibly operational complexity. And most investors are looking for a steady path to profit, but NIO is currently bleeding cash. In Q3, they reported a net loss of $721 million, which is an 11% increase from last year. So right now, they're relying heavily on external financing to stay afloat. However, it's not all bad news. Some metrics are improving, like gross margins rising from 8% up to 10.7%, but they're still lagging behind competitors like Tesla and BYD. And with the economy being uncertain, NIO can't afford to fall further behind companies with stronger balance sheets. In addition, the competitive landscape for EVs is tough. Tesla and BYD are scaling their supply chains effectively, while NIO struggles to keep up in terms of brand appeal and cost efficiency. And NIO is trying to break into new markets, but with geopolitical tensions rising and established automakers like Volkswagen and BMW already in place, this is a mammoth task. Plus, high tariffs on Chinese vehicles complicate matters even further. Now let's talk about NIO's share price. It has fallen significantly over the past few years, from the peak of $62 in early 2021 to around $4 today. A relative valuation analysis suggests a fair value for NIO around about $10.48 a share, but the market isn't likely to change its mind until NIO shows signs of profitability. Wall Street analysts are somewhat optimistic, with most leaning towards a buy rating, but many suggest a cautious hold. The lowest price target is just $3.51, not far from current levels, indicating that negativity may already be priced in. Having said this, we know that stocks like NIO can be speculative, so the stock price can take off before the fundamentals make sense. Despite efforts, NIO is still losing money on every car sold. They've received temporary relief from government-backed funds, but this doesn't encourage further investment. With $7 billion in cash and short-term investments, there's still room for growth, but this cash could run out quickly without sustainable profits. Don't get me wrong, NIO does have a lot to offer. Its battery swapping tech and its brand are intriguing. However, right now, it doesn't present itself as a sound investment when you just consider the company's balance sheet. With ongoing losses, increasing competition, and heavy reliance on external financing, I currently see NIO as a speculative investment with high growth potential. Whilst I would not consider NIO as a buy right now, I would certainly add it to my watch list for the future once the share price gets going. If you're keen to know which share price levels would indicate NIO is starting a new uptrend, check out this video here, where I look at NIO's charts from a technical perspective and offer a price prediction for 2025. See you there.